How to start trading and investing. Finance explained. Financial independence, early retirement, a third income. You've probably heard a lot about why you have to start investing right away from your friends or your colleagues, and it sure can be quite intimidating to not know where to start. You can be able to raise your money several times over with time if you constantly invest your money. Because of this, it's crucial to start investing as soon as you have any money set aside for the purpose. Furthermore, the stock market is a fantastic place to start. Welcome back to Finance Explained, and today we will simplify the whole process of trading and investing for you. Remember that it's better to start and learn along the way than to not start at all. You can begin investing from your $1,000 that you have saved up, or if you can simply afford an extra $25 a week. But on a stock exchange, an investor cannot immediately purchase or sell shares. Stockbrokers are officially recognized participants in a stock exchange. They carry out trading for an investment. Because a stockbroker is knowledgeable with market formalities, you may rely on their insight and experience. They may help you choose wisely in the marketplace. Modern world trading and investing requires at the most a demat account. In order to start trading in the stock market, an investor must open a trading account and a demat account, which must be connected to the investor's bank account for online money transfers. This will help you get used to the interface and provide you access to research and trading tools that are exclusively available to customers of stockbroking firms. Money will be taken out of your bank account on purchase of a share using your trading account, and then the share is placed in your demat account. Shares will be moved from your demat account into the stock market when you sell them. Your bank account will be credited with the proceeds of the transaction. Let's start by discussing the part of your income that you shouldn't put into stocks. Money that you could need within the next 5 years, at the very least, should not be invested in the stock market. This, for example, includes your savings account or the money you would require to pay off your child's tuition. It is also essential to understand that there are two categories of trading. An intraday trade is one which enables you to buy and sell more stocks than you might normally without having to make a larger financial commitment. You must close out all open positions in intraday or day trading before the market closes. You can employ margins for intraday trading, which are funds the broker gives you to boost your exposure to the stock market. Delivery trading is purchasing the stocks with the purpose of keeping it for a longer period of time than just a day. You must have the money for your share market investments because it does not use margins. The next two terms to be familiar with are bulls and bears. A bull market is the state of a market in which there is a broad increasing trend and which is distinguished by a general sense of optimism among investors and a belief that prices will continue to climb. A bear market is a state of the market where there is a broad downward tendency in prices. This is defined by increasing selling activity and pervasive pessimism among investors who expect that stock prices would fall. Another two terms would be long and short. If a shareholder is purchased and now owns the shares, that investor is said to have a long position. On the other side, an investor is said to have short positions if they owe these stocks to another party but do not own them. To make this clear, an investor is considered to be 500 shares long, for instance, if they purchased 500 shares of Company X. This assumes that the shareholder has paid the entire price for these shares. The investor is said to be 500 shares short if he or she shares 500 shares of Company X without actually owning them. This frequently occurs when an investor borrows shares from the brokerage company to deposit into his margin account in order to make the delivery. This investor must now pay 500 shares in the market in order to make a delivery at settlement. If you're still watching this video, click subscribe and also keep watching to know our equation for investing. As an investor, it is possible that you may own either of these stocks. Individual stocks. Individual stocks are only an option if you have the time and motivation to thoroughly investigate and continuously assess stocks. If so, you must wholeheartedly be up to take action. A wise and persistent investor has a good chance of outperforming the market over time. On the other hand, it is also not wrong in adopting a more passive strategy if things like quarterly earnings reports and straightforward mathematical computations don't sound appetizing. Index funds. You have the option to invest in index funds, which follow stock indices like the S&P 500, in addition to purchasing individual equities. One advantage is that the fees of index funds are often far cheaper, and they almost always reflect the long-term performance of the underlying indices. Robo-advisors. The robo-advisor is a last choice that has gained enormous appeal in recent years. A brokerage known as a robo-advisor essentially invests your money on your behalf in an index fund portfolio that is suitable for your age, risk tolerance, and investment objectives. A robo-advisor may choose assets for you, and many of them can optimize your tax efficiency and make adjustments automatically over time. The conventional consensus is that stocks eventually lose appeal as you age as a place to invest your money. If you're young, you have decades to ride out and set off on any market ups and downs. But if you're retired and dependent on your investment income, this isn't the case. This is why you've heard of the importance of starting to invest early. We will provide you with the best equation in terms of investing. Add 110 to your age, then subtract it. This is the approximate proportion of your investable funds that you should put into stock investment, which includes stock-based mutual funds and exchange-traded funds, or ETFs. The remaining part of your portfolio must be filled up by bonds or high-yield CDs. Depending on your own situation, you can then increase or decrease this percentage. This ratio can also be changed based on your personal risk tolerance. Let's say, for example, that you are 40 years old. According to this approach, you should invest 70% of your investable funds in equities and the remaining 30% in fixed income. You might wish to tweak this ratio in favor of equities if you're a risk taker or intend to work past the traditional retirement age. On the other hand, you might want to change your portfolio in the opposite direction if you don't enjoy significant changes in it. Choosing a brokerage account as per your requirement is important. This involves choosing between a conventional brokerage account and an individual retirement account, or IRA, for the majority of people who are just beginning to explore stock market investing. You can purchase stocks, mutual funds, and ETFs using either type of account. The primary factors to take into account here are your investment objectives and how simple you want it to be to access your funds. A conventional brokerage account is probably what you want if you want quick access to your funds, are only saving for a rainy day, or wish to invest more than the yearly IRA contribution maximum. However, if your objective is to create a retirement fund, an IRA is a terrific way to do so. It is also important that one must be familiar with the concept of diversification, which states that your portfolio should contain a range of different types of businesses. Keep your investments in companies you are familiar with, and if you find that you have a particular flow with stock analysis, there is nothing wrong with having a sizable portion of your portfolio invested in that particular sector. It is important to note that every successful investor has, at some point in their career, had a mentor. Finding someone who has some experience in this area and can mentor you through your journey is crucial if you're new to the investment industry and are studying stock trading. Your mentor can assist you in developing a learning path, suggest classes and reading material, and keep you motivated despite market ups and downs. One proverb to remember is that failing to plan is planning to fail. Any person who is serious about succeeding, especially traders, needs to have a plan in place for their stock market investments and trading. Making wise investing decisions through your trading strategy is crucial. So is choosing your investment amount and the length of time you want to hold the assets. In light of this, you can arrange your buy and sell orders based on the cash flow and exposure that you have established in accordance with your intended strategy. And with that, we come to the end of this video. We hope you were able to understand the tips and tricks to investing, so don't wait and don't forget to start investing right away. If you found this video helpful, click like, share, and subscribe. See you next time.